All right, it's a busy week for the markets. The Fed kicks off a two-day policy meeting tomorrow with stocks near new highs. Joining us is David Bahnsen, Managing Director and CIO of the Bahnsen Group, and James Camp, Managing Director of Strategic Income at Eagle Asset Management. All right, David, we'll start with you. You have counted how many cycles of tariffs, easing of tariffs, market goes down on the tariffs, it slowly rebounds. Actually, it doesn't rebound immediately. It sort of stabilizes and then rebounds after we think that maybe some positive things are happening. And that's what we're still vulnerable to at this point?
I think we're vulnerable to it. This one does sort of feel like it's possible that we might actually get some kind of a more lasting temporary resolution, and that paradox is on purpose. I think that this time the political implications are much more severe. When you go back to the first couple of times this happened, the president still had a lot of time to work through it and so forth. But I think this time maintaining the strong economy narrative into the election year is very vulnerable, and he seems much more motivated to get it done. The difference is China. I'm not sure that China is operating from the same point of weakness that they were 6 months ago, certainly a year ago. They seem less concerned about their vulnerability, but their vulnerability is not in doubt.
James, on the fixed income side, you're still not sure what goes on in terms of Fed and everything else, but just take a step back and just go into the 2 year and just wait at this point. Is that the best move?
Yeah, I think one of the things you look at in the capital market space is it's sort of been a year where almost everything worked. I mean, the income side from the equity income side has worked. The bond market has worked. And so when those correlations move sort of positively together, we like to take a little risk off the table. And right now, the two highest yielding assets on planet Earth are the T-bill or the Fed funds rate and 30-year Italian debt. I'm not a buyer of 30-year Italian debt, so parking some money in the short end of the Treasury curve and let this play out a little bit makes a lot of sense right now.
Quite a backup in rates after the events of the weekend, too. And it had already bottomed, and the 10-year had already started moving. Where do you think the next resistance level is? You think we get back above 2% near term?
Yeah, Joe, I think this is a complete redo of the two other periods we've seen 150 on 10s. We've had these sort of call them mini pauses, mini recessions in this expansion. And so the 150 level to us was the line in the sand for the bond market. It held. You certainly could see a 2% level. You've got to get the funds rate inside of 2 to get some slope in the yield curve if that's the situation. I think that's exactly where the Fed is going to go. They're going to ease tomorrow, or pardon me, on Wednesday, maybe one more in October, and then you see some positive slope to the yield curve, and a lot of those sort of technical things that concern people about economic slowdowns go away. So I'd expect a 2-year, 10-year, and I'd expect a 175 funds rate.
Fed matter to you, David?
Oh, it does. I mean, I think that in terms of the liquidity that they were taking out of the market in fourth quarter of last year, that doesn't seem to be at play right now. There's plenty of liquidity in the market that is, there for risk assets. But I think as far as the shape of the yield curve, the thing that I'm not sure I agree is that it can hold when the Fed brings the short rate down.
It's not just the Fed that's moving this
week.
You've got the Swiss National Bank,
well,
you've got
and
the Bank
Germany,
of Japan,
the entire
and
ECB.
the Bank of England. Everybody's moving this week.
That's
You're
right.
going to hear more from them, too.
That's right. And I think that those amount of assets pouring into the long end of our curve is going to continue to hold that yield down, and I don't see that changing anytime soon.
So your strategy at this point is do you care about growth? Do you care about value? Do you buy the dips? Do you, go for yield stocks?
Yeah, so we're not yield stock people. We're growth of yield stock people. We want dividend companies raising the dividend over time. And you look at like the events of this morning, Chevron and Exxon. See, we would never buy something because we think there's going to be a shock to oil supply. Chevron and Exxon are 5%, 4% yields. These are companies that have grown the dividend through far worse economic periods than we're going through right now. I think it's sustainable dividend growth from two really good companies. You just get an added benefit that they happen to be somewhat defensive in certain geopolitical situations.
So you would have bought them before this even?
Oh, we were heavy owners of this before them and had been buying heavily throughout August. Absolutely.
Right. James, if you had to park money in fixed income, when do you think the next buying opportunity would be for something like a 10-year or even longer than that? Where do you think we're headed? Are we permanently at these low levels?
Well, we're going to move as global GDP moves. And in the post-crisis period, as global GDP goes, so goes the 10-year. My only short-term trade where I think rates could back up a bit is inflation has come off the mat domestically, and inflation does matter for longer-term yield. So I do think we were overbought at the 150. I do think the Fed gives us a little bit of a pause. And so if global economy sort of stabilize, if we get some sort of fiscal activity out of Germany, which I think we will, and you start to see these inflation numbers, certainly not problematic, but with the oil events over the weekend, you're going to see some pressure on those numbers. And so I think the dramatically overbought levels are behind us, and I wouldn't be surprised if you had a 2%. But being agnostic about where income is generated, I completely agree with David. You want to have a balanced portfolio of steady, second quintile, growing dividend stocks, non-correlated bonds, meaning not bond proxies. And if you do that in this environment, you're going to have a competitive and growing income stream, sort of regardless of where absolute yields move. You've got to be flexible in what parts of the capital structure you pick, and we 100% agree with that. 2% would be a buy. I don't know that we'll get there, but that's certainly the level that we're looking for right now.
Do you watch high yield, especially in the energy sector? James, can you tell me what's happening there? This probably help if rates go, or if oil prices were to go up at least 5-10% from where they were. A lot of debt from those with those players, right?
Yeah, and I would argue that a lot of the debt that went into the MLP space, and certainly a couple of years ago, was over leveraged. I think you had a lot of people that were buying yield for yield's sake. If you have good, high quality integrated oil, either on the debt side or on the equity side, you're going to do just fine. If you're doing speculative oil trades based on commodity prices, I think it's a fool's trade, and I would be very reticent to do that. Oil is not going to 100. The oil dynamics are not the dynamics of our youth. Joe, you and I, we do not have the same sort of shock in directionally higher rates in oil prices. This will be a very short-term phenomena, just because of the massive capacity that's been built, both domestically and other players.
Look, although this brings into the idea that these resources are much more vulnerable than I think any of us had anticipated before, and we don't know what happens next.
I think that the debt aspect,
but they're more but they're more globally dispersed, Becky. That would be the argument that I would make. When you have the U.S. as a net oil exporter, we weren't there back in the 70s or during the Gulf War. So I think it's a different global dynamic in terms of the supply chain.
I think back to the debt issue. Energy sector debt was 38% of the debt in the S&P 4 years ago. It's 20% of the debt in the S&P now. There's been significant deleveraging. And the issue about this becoming an inflationary shock, I just want to point out, this is a huge story. Oil is right now where it was July 10th, where it was May 24th. I mean, $59 is not exactly what you would think of as a world panic around oil prices. So I don't think that we can anticipate any inflationary lasting concern out of this.